This is The Top, where I interview entrepreneurs who are number one or number two in their industry in terms of revenue or customer base. You'll learn how much revenue they're making, what their marketing funnel looks like, and how many customers they have.
I'm now at $20,000 per top.
5 and 6 million.
He's hell-bent on global domination. We just broke our 100,000 unit sold mark.
And I'm your host, Nathan Latka.
I just finished traveling Southeast Asia for 41 days, and I usually always get sick when I travel, and quite frankly, eating is difficult for me. It's hard to find a restaurant, and I'm spoiled in Austin with my personal chef. Well, I took these little packets with me this time, 30 of them, in my carry-on suitcase. They kept me totally healthy with 11 different secret ingredients. You can see them at nathanlatka.com/juice. I'll tell you more later on in the show. That's nathanlatka.com/juice. Folks, many of you reach out to me and you say, Nathan, so many guests on your show talk about the importance of batching. But whenever I try and batch, you tell me this. You go, Nathan, they don't book back-to-back times. Or they don't show up after they book. It's frustrating. The answer is, guys, you have to use smart tools. I use a tool called Acuity Scheduling at nathanlatka.com/schedule. I'll tell you specifically how I use it later on in the episode. This is episode 671. Coming up tomorrow morning, Adam joins us, who runs his own agency, and he breaks down how to run from an agency model where you have to hustle for new clients every month to a software model with predictable revenue. Be sure to tune in, especially if you are an agency founder, and tune in every morning for a new episode. Good morning, guys. Nathan Latka here. My guest this morning is Steve McLaughlin. He is one of the founders and CEO of Financial Technology Partners and former senior banker at Goldman Sachs, covering FinTech for over 20 years. He was recently named Investment Banker of the Year, ranked number 2 banker in Silicon Valley by The Information, which, by the way, they've got a very interesting business model. And he's top ranked on Institutional Investors Online Finance 35 list of most influential people in FinTech. Steve, are you ready to take us to the top?
Ready to do it. Let's go, Nathan.
All right. So we had John Stein on in yesterday's episode with Betterment. In episode 469, we had on Andy with Wealthfront. You are actively playing in the financial technology space. Give people an understanding quickly about how you're playing in this space. What do you do?
Sure. My company does 2 things. We advise firms across the entire FinTech landscape on raising capital and M&A. So we're usually on the sell side, helping people figure out where to get money, how to get money, what the valuation is, what the structure is, you name it, or where to find a buyer, or both at the same time. So that's pretty much what we do across everything from wealth tech to payments to insurance tech and any other part of FinTech.
So take us back to last year. Give us a sense of kind of total transaction volume you were involved with.
Sure, probably 10, 15 billion of total transaction volume. Largest deal was probably $4.5 billion. Smallest was probably raising $10 or $15 million, for a wealth tech company, actually. So you kind of mentioned these 3 sectors, kind of wealth tech, you have then payments, then you have kind of like robo kind of advisor things. It sounds like that's how you're categorizing these. Which one of these industries, well, my question is going to be, which one of these industries are you seeing kind of the highest valuations in from buyers or potential investors? But I think I'm going to change my question to, which of these industries are you most excited about? Are you seeing the most interesting deals in? Really it's across the board. I mean, everything from B2B payments to consumer payments to online lending, companies like Prosper or GreenSky. In the payment space, like Marketo is growing at hundreds of % a year. It's all over the map. But in the wealth tech space, that's one of the ones I think is going to be a little bit slower to ramp, but has probably the most staying power long term, because you just keep piling assets on top of each other over the years, and the stickiness level for some of these platforms like Betterment and Wealthfront and others is huge. So any other
players you see in the space besides those 2, Betterment and Wealthfront?
Well, I like some of the guys that are doing B2B sort of arms race kind of guys like Riskalyze, who are basically behind the scenes providing the same kind of technology to RAAs and other advisors, or someone like a BlackRock, who we advised last year in buying a company called FutureAdvisor. So you got the guys that are going directly after the consumers. And we like Betterment and Wealthfront quite a bit. We also like Personal Capital and some of those types of players. But the B2B guys we like as well. So it's a lot of good activity. So
let's dig into that deal you just mentioned with BlackRock. It was called FutureAdvisor.
Yeah, Sequoia-backed company, kind of startup, and was going initially after the consumer side, pivoted a little bit to be a B2B player. And, can't say the size of the deal, but you can Google it and it's out there. It's a pretty large transaction, given it's BlackRock. But, their angle was really just, how do we go out and arm, all the different advisors across the globe, with this robo technology that is being offered to consumers directly through the internet. How do you do bricks and clicks or human and internet, so to speak?
Yep. And guys, just so you have context, according to just my research, this is not Steve confirming this, but according to my research, that was BlackRock acquiring FutureAdvisor for about $150 million back in August 27, 2015 it was. So healthy deal. Were you on? So Steve, paint FT Partners into this for a second. Were you on the cap table at FutureAdvisor, or you were just brought in at the end to maximize the exit?
So interestingly enough, I mentioned at the beginning, we generally are on the sell side. On this one was an unusual one. We were on the buy side. So we actually got hired by BlackRock as an advisor. So we got paid an advisory fee for advising them on, how to do the deal, what to pay, how to think about it, how to structure the, compensation and other things like that. So, and what was going on with the other deals in the industry. So we were their advisor. So, we, like I said, normally are on the sell side, but, we've been hired by BlackRock on the buy side, Google Capital, Ally Bank, CIBC, Nomura, some very large FIs, financial institutions have brought us on their team to learn how to buy these sort of startup companies.
And how do you, tricky. Yeah, it is. And for people that are not familiar with kind of this space, how do you make money? I mean, what's your business model? Sure.
I mean, generally, we give advice for doing large transactions. So someone calls us up, they want to raise $100 million or $200 million, or they want to sell for $1 billion, or they want to buy a company for 150 or 200 million, or whatever the number is. We're basically paid on success. It's some sort of commission, usually on a percentage basis of the value of the deal. Sometimes it's related to how high the deal is. The percentage can go up and up and up as we have more value. So we're in there, putting presentations together, doing market research, contacting buyers, developing valuation thesis work on these deals, and essentially putting buyers and sellers together and trying to make a market for these companies. Sometimes we get hired by the seller and there's just one buyer and we're going to talk to that one buyer. Sometimes we go out to 50 buyers. Sometimes it's going out to just U.S. buyers. Sometimes it's China, Asia, the rest of Europe, and the rest of the world. So it can be very wide, it can be very narrow.
And I understand there's variation based on deal size and in terms of what you take. But I mean, is this similar to other brokers? Let's say you're averaging 3% of the deal size?
It's different, on a multi-billion-dollar deal, it can be 1%, and on, a $100 million deal, it can be 7%.
Got it.
So it kind of scales with the deal size. And then some of the fees can be pretty large. If you end up getting a much higher price than people were expecting, you can get a bigger percentage.
So I want to do a hypothetical with you because I think this hypothetical might actually come true in the future, but don't confirm or deny this. So if you have insider knowledge, obviously don't share that, but assume what John just told me on yesterday's episode is accurate. And that is that Betterment has passed $8 billion in assets under management, and their model is 1/4%, right, on assets under management, right? So people can do the math and figure out what their revenue is. BlackRock has hired you, or some other big company has hired, Vanguard has hired you, and they want to buy a company like Betterment. How do you value a wealth technologies, company like Betterment?
Sure. I think the last thing we would do is look at, AUM or revenues today. We would sort of look at what are all the factors affecting Wealthfront or a Betterment, and, what do we think that company's going to look like in 7 to 10 years? So if everything goes according to plan, they become a dominant provider and have $800 billion. At that level, they're going to be at scale. They're probably still going to be growing quite quickly. They're going to have EBITDA. They're going to have real earnings, real margins. And we would look to see what it was worth out in the future. So you'd run 50 different scenario analysis to figure out, what the company might look like in the future, and then start picking the ones you think really reflect your personal view of the future. And then that's a certain dollar amount in the future. And they say, what would I be willing to pay for that today? And that's a function of what return I would require for taking that risk. And so we're always looking out 5, 10, 15, 20 years and saying, what could a company be worth? And then saying, how do we get value for that today? So it's much more complicated than just looking at a company's current revenues or current earnings, particularly for these higher growth companies like the ones you're talking about. So it's very esoteric. It's probably one of the hardest things to value in the world is a high growth private company that doesn't make any money, right? Because at the end of the day, there's no money flowing out the bottom. So what is it worth? Some people might think it's worth nothing. Some people might think it's worth And Snapchat, $25 billion. These are tricky to value companies.
You guys probably at FD Partners, you see a deal like Snapchat at the partners meeting on Monday, and you go, "Thank God we're in the financial technology space."
Yeah, should have started a Snapchat app.
So both Andy at Wealthfront and guys listening, if you want to go back and hear all of Andy's data about Wealthfront, you can go back and listen to episode 498. John's he revealed it all yesterday. Companies like this, both Andy and John, Steve, would brag about the fact that when you look at the growth of ETFs in terms of assets under management, both of them are growing significantly faster than the adoption of ETFs. I assume that's kind of a metric you're going to use to try and predict what they're going to look like in 5 to 10 years. Is that accurate?
Yeah, I mean, I would look at pretty much any trend that could mimic what they're doing, or that they could be an example of. I mean, if you look at how mutual funds took off, or ETFs, or index funds, the question is robo advice, on a platform that's direct to consumer, going to mimic what happened in mutual funds, index, ETFs, and other categories over the course of time? I think the jury's out on that.
What do you believe?
I think that it's first of all, I think you can have a lot of winners, right? You had a lot of companies in the mutual fund industry that didn't win. You had a lot of that did, and sometimes the ones that won big time were in the second wave. So there's no saying that the guys who invented the popularized robo-advisor are going to be the winners, but I tend to think those companies are going to do quite well. I'm not an investor of those companies, but I know those guys. I see them from far. I'm a big fan. So I think they're going to be winners. And I think they've already proven that to some extent, because they've outlasted lots and lots of other guys that have tried to do it, right? Even like a FutureAdvisor who tried to do that and pivoted to B2B is now working with BlackRock. So a lot of the guys that were doing B2C, never really developed the brand name, developed the technology. And the thing I'm most proud of as it relates to these companies for them is they've raised a lot of money, and I think they care a lot about the consumers behind the platform. And they realize that if people actually manage their money correctly over the course of time, it can create a much better society, because these people will retire better, save more money, be able to donate more as they get older and things like that. So there's sort of an odd social benefit to this whole thing. When I sat down with some of those CEOs of these companies, that's some of the things they talk about. It's hard to imagine people going their whole life just investing poorly, making bad decisions, and getting chopped at the knees on fees every year. Just the fees alone can greatly impact your retirement, and some bad decisions along the way, which I think generally the robo-advisor is going to keep you from making terrible decisions, which a lot of people do, selling when the market crashes or buying when the market spikes, or not doing tax loss harvesting and things like that. So I think there's a lot of power in these models. That being said, I think it's really hard to build a consumer brand. And I think that the empire will strike back, so to speak, with the BlackRocks and guys like Riskalyze, who are growing like a weed right now.
What's Riskalyze do?
They have various risk tools and robo-advisor tools that they sell into RIAs. So,
sorry, what was the acronym? What was the acronym you just said?
RIAs, Registered Investment Advisors. Registered Investment Advisors. So, they might sell into a Raymond James, for example. I'm not saying that's a client, but in this example, they've got thousands of financial advisors who, 2 years ago would sit across the desk and give personal advice, and there wouldn't be a robo component necessarily. But, going forward, they can be armed with the very same or similar tools that someone like a Wealthfront or Betterment would give directly to a consumer. And the fact is, like, some consumers like to do things extremely self-directed, and some like to have a human sort of working with them, sort of working the robo-advisor technology behind the scenes. And some people like a pure hybrid where they want to do some themselves and some with a human. So it's I think all the models can succeed. We're still in the first inning. There's hundreds of mutual fund companies that did incredibly well. The key is sticking at it and having the funding to do it. I think that's one of the problems I'm seeing in Silicon Valley is a lot of these companies, not necessarily these wealth management companies, but in general, are not getting enough funding. Everybody wants to build
FinTech companies.
Multi-billion FinTech companies, exactly. There's no one that's really putting, $500 million behind these companies, right? It's always dribs and drabs of 10, 20, 30, $40 million. You did see Betterment raise $100 million from Kinnevik in Europe, which I thought was tremendous for them to be able to have that kind of capital to kind of build the technology they really need to build and be able to do the kind of marketing they need to build their business on. So I think, the arms race for raising capital, which is where we come into play, is critical. And I think it puts pressure on the other guys in the space to raise large amounts of capital and really build the business.
What I struggle with, Steve, and I'll be transparent. I'm going to talk me personally for a second. I'm a big fan of Warren Buffett. Go to all the the annual meetups and all that jazz. And I just stick to his advice, right? Which is, I'm not going to be active. I'm never going to beat the market. I'm never going to do this stuff. I'm just going to put it in a passive, low exchange ratio Vanguard S&P 500 index, and that's what I do. And there's a significant amount of money that I have there. I was hoping Andy or John would be able to convince me to take a shot at one of them, throw 10 grand into both of them, see what happens over a few years, do a comparison. The fact is, I just don't understand why I would do that, right? Their argument would be, well, we're going to save you more with real-time tax loss harvesting, which Vanguard can't do. The problem is their fees are a little bit higher than what I'm doing in Vanguard. And Warren Buffett says you have to keep your exchange ratios low. So why isn't Warren Buffett recommending Betterment and Wealthfront?
I mean, he probably doesn't know much about Betterment and Wealthfront. I think one of the things that I like about Betterment and Wealthfront, they're going to have really, really forensic case studies on decent swaths of the population where they're going to be able to sort of take, over 10 or 15 years, this part of the population that got on their platform and they put a significant amount of assets on the platform and see how it performs through the cycles. And they'll be able to compare that net against what you're doing in Vanguard index funds or what someone else is doing, investing in a bunch of single stocks or hedge funds or putting their money in checking account. And there will be perfect comparable data on which was better, right? And so I think you're starting to get to a point where you'll have empirical data that'll say which one was better. Right now, I can't say it will be better to be in Vanguard or Betterment or Wealthfront. There's a philosophical view as to one might be better, but they've both got very technical approaches to the robo advice. And eventually it's going to be clear which one was better. And so I think as you get more and more of those case studies, more about that empirical evidence, once people realize smoking, kills you, a lot of people stop smoking. Not everybody. You still can't, people can't help themselves, right? But you still had a huge march towards that once you get some empirical evidence that these robo-advisor platforms and the value of the lower fees and the tax harvesting and things like that are super, powerful over the long haul. That empirical data is going to really propel people to just throw money in these things in droves. Whether that's with a Riskalyze or with someone like a Wealthfront or Betterment.
Guys, I get asked all the time, Nathan, you host all these interviews, hundreds of them per month. How do you do them efficiently? And guys, the answer is simple. People always agree to my calendar, back-to-back meetings. I batch my interviews to stay very efficient. And the way that I do it is I use a tool called Acuity Scheduling at nathanlatka.com/schedule. And the reason I use them is very simple. They keep my no-show rate very low because they send out reminders about when the interview or the meeting is coming up. And also, they make it very easy to schedule time, right? I don't have to go back and forth via email 10,000 times with people I'm trying to meet with. Okay, at nathanlatka.com/schedule. Helps me so much. And by the way, look, I have so many meetings. I'm the best at meetings. Okay, I do them back-to-back, very, very efficient. You guys know me. Many people say I'm the most efficient they've ever seen. Okay, so I use the tool. It's so efficient. And by the way, I got Gavin. I said, Gavin, he's the CEO. I said, I want a great deal for my people. He said, Nathan, well, most people get a 14-day trial. Isn't that great? I said, no. He's given us a 45-day free trial at nathanlatka.com/schedule. That's not going to stay up forever, so go get it now. nathanlatka.com/schedule.
John, Steve, on that note, let's wrap up here with the famous 5. Number 1, what's your favorite business book?
Probably Jack Welch, From the Gut.
Number 2, is there a CEO you're following or studying right now?
Not really. I mean, I like Jack Dorsey because I'm a huge fan of Square and I'm a huge fan of Twitter. And I think despite the fact that both companies have been thrown under the bus over the course of time, I've been a huge fan of both. And so he's someone I think is pretty amazing and able to start and run 2 pretty epic companies.
Number 3, what's your favorite online tool, like Acuity Scheduling?
Favorite online tool? Uber.
Number 4, how many hours of sleep do you get every night?
If I'm lucky, 4 to 5.
Awesome. And what's your situation? Married, single, you have kids?
I have a girlfriend. She's awesome. No kids just yet.
Awesome. All right. And last, and how old are you, Steve?
48.
All right. Last question. Take us back 28 years. What do you wish your 20-year-old self knew?
Oh, boy. Well, I wish I knew where all the stocks were going. That'd be good. I wouldn't have to do this.
Spoken like a true FinTech investor.
Exactly. No, I enjoy and totally love what I do. It's our clients are awesome. Just really, I think, spending more time with family and friends along the way, and you can get too wrapped up in work. So, work-life balance is critical, and hopefully all of our employees are taking advantage of that as well.
There you guys have it from Steve, again, founder and CEO of Financial Technology Partners. After being a senior banker at Goldman Sachs, he's been in the space for well over 20 years, doing billions and billions of dollars of transaction volume every year in the financial technology space. He's bullish. He's excited. Steve, we're going to stay in touch. We'll follow up. Thank you so much for taking us to the top.
All right. Thanks, Nathan. You're the man.
If you enjoyed Steve today, go back and listen to John Stein yesterday, who runs Betterment. They've passed 200,000 investors and $8 billion with a B in assets under management. And my question to John was simple. John, how do you beat Vanguard and Wealthfront? He answers, you tell me if you agree. It would mean the world to me if you guys got any value from this episode, if you would go leave a review on iTunes right now and then subscribe. I hustle like heck to get these episodes out every freaking day for you guys. And trust me, I love it. I would do it with no listeners, but boy, oh boy, it makes my day and it makes my team's day when we see great reviews and get your feedback. So thanks so much. Okay, Top Tribe, I love giving away free money. I feel like Oprah giving away cars, and I have something special for you today. How many of you have heard our super sharp guests talk about success they've had with Facebook and Google ads? Well, all of you listening right now, yes, if you're listening, you get $100 in free AdWords. Here's how you get it. Okay, again, thanks for listening. Get the free $100 from Google right when you sign up with my website host provider, HostGator. Go sign up now to get your free money. HostGator.com/Nathan. Again, that's HostGator.com/Nathan. So guys, I'm so glad to be back in Austin. I just got back from a major tour of Southeast Asia, went to Sydney, Bangkok, Bali, and Japan. And, I always get sick when I travel. And this particular trip, my gosh, 15 different airports, 20 different hotels. I mean, imagine flushing in airport bathrooms. I was worried about germs and getting all the nutrition I need. I mean, finding a restaurant in Japan, difficult because nothing's in English. So it's hard enough to figure out the train system. But my point is, I had a guy named Drew Canoli on the show who said, Nathan, if you're concerned about that, take these little green packets with you. You just mix them once per day with water. They'll keep you super healthy. You get all your nutrients, and they'll keep you from getting sick. So I took them, and guys, they worked unbelievably well. I got no sickness, just mixed them with water once per day. They didn't make my water bottles all sticky. That's nice. A lot of these mixers, they make them sticky. It was very clean and smooth. Took them once per day, never got sick. So they've got 11 superfoods, and they're perfect if you're not traveling, but you're just on the go from your office to work. So you can check them out at nathanlatka.com/juice. That's nathanlatka.com/juice.